You may have heard that the Federal Reserve has been aggressively hiking interest rates in an effort to slow down the rampant spread of inflation throughout the economy. This brings up the question, how do interest rates actually affect inflation? When interest rates are low, there tends to be higher spending that takes place in the economy. As people and businesses spend more, the speed that money travels between parties in the economy speeds up. This is because lower interest rates mean that the overall cost of debt is lower since interest payments on that debt are lower. When people and businesses are able to borrow money at cheaper interest rates and pay less in interest over the lifetime of that loan, they are more likely to be willing to take out loans to finance business investments and other purchases that they want to make. This increased borrowing because of low rates acts as an economic stimulant. Since people are exchanging money at a higher frequency and demand for goods and services is increasing in the economy, money starts flowing between parties through the economy at an accelerated rate due to the cheap financing from low rates. This increased spending can help to increase inflation. As businesses look to keep up with different supply shortages and the increased demand that they're experiencing from consumers for their goods and services, they might have to raise their prices to try and slow down the demand surge that they're struggling to meet. When interest rates are higher, the opposite effect is actually taking place. Demand tends to slow down because people and businesses are less likely to take out loans to purchase things because debt has now become more expensive. Now, in order to borrow money, they have to pay higher interest rates throughout the lifetime of the loan, which is less appealing. For example, if a family wants to buy a house, it's more attractive to buy that house when interest rates are lower on mortgages, since this reduces the amount of money the family will be paying in interest throughout the life of the mortgage. So during a low interest rate period, the family is more likely to take out debt and spend their money to buy that house. But if interest rates are higher, they might decide to delay buying that same house until rates are lower and they can get a better interest rate on that mortgage. So you can see how rates directly affect purchasing decisions in the economy. In addition to it being less ideal to purchase things with borrowed money at higher interest rates, since the loans become more expensive, higher interest rates also tend to incentivize people in the economy to save their money, since their money can collect higher interest payments. When it's possible to save that same money and get a higher return by loaning your money out instead, this tends to reduce the amount of money people are using to purchase things because it incentivizes saving. So this contracts the circulation of money throughout the economy because people are now holding on to it. So by raising the federal funds target rate, the Federal Reserve can decrease overall spending, investment, and slow the velocity of money circulating throughout the economy, which can help to cool inflation. With less demand for goods and services due to the higher interest rates, this can help to stabilize prices since there are less buyers competing for the goods and services, which leads to prices becoming more competitive and less likely to be pushed up by overwhelming demand. This is why interest rates are an important tool for managing inflation and the overall economy. By raising interest rates, the Federal Reserve is aiming to cool inflation. If you like this video and want more educational finance content, please make sure to like this video and subscribe to the channel. Thanks.